Begin by saying good morning to everybody that I haven't said good morning to, and welcome to the seventh installment of the LIAFPN virtual meeting. We've been having lots of fun with these. Today, we're very excited to introduce, if you haven't noticed, our new website, which is liafpn.org. You can get there by liafpn.com or .org. Several of us will be having websites. There's membership forms there if you're not a member yet. And we welcome everybody and encourage everybody to participate, become a member, because that's what's funding these Zoom meetings and getting in tremendous talent to talk. Today, we're going to have Phil Kanyuk and Larry Bloom, who are both on the advisory board for us, talk about business valuations in these times. And with that, I'm going to hand the mic over to Phil. Phil, just let me turn the mic over to you here. How do I make you the host? Make host. There we go.
Yeah.
Very good.
All right.
So before we get started and Phil gets into his presentation, again, I just want to welcome everybody. For those of you who have been with us for the long ride, the whole term, you might recall about 2.5, 3 years ago, we did it was a live presentation on business valuations where Phil presented a case study. And the case study was more geared towards valuations in terms of estate and gift planning. Today, we're really not going to address the estate and gift planning arena and minority interest discounts and lack of marketability and those things. We're going to focus more on how valuations are impacted by certain external forces, most specifically what we're facing now, a pandemic. Phil will go into different valuation techniques and concepts that are used in valuations and as it relates to that. And then at the end, Phil and I are going to go into a discussion regarding a particular industry and how it was impacted by this COVID crisis, and maybe shed some light on what's going on. We're going to stay away from the entertainment and hospitality. We're going to focus on a local industry and companies that we're all kind of familiar with, and just identify some of the issues that are related to this situation and how it impacts value. Neil and myself will be monitoring the chat room if you have questions, and we'll interject Phil as Phil's speaking his presentation. So Phil.
Thank you, Larry. Larry will keep me in line and help to move me along. Thanks for joining us this morning. I do encourage asking questions and giving Larry some ammunition to interrupt me and stop me from talking, and trying to keep it a little bit more relevant to everyone's experiences and issues. It's a pleasure to talk about business valuation, and those that know me know that I like to tell stories and like to talk. So having an audience is a wonderful thing in the business valuation world. I'm very passionate about my specialty. I've been doing this for 30 years. If you've seen me in the courtroom or in a mediation, arbitration, or settlement meeting, you'll have observed an individual who gets very passionate with a very simple topic of business valuation. And I try to boil it down to the very simplest points with the ultimate end game of knowing that my valuation conclusions for a variety of purposes might need to be explained in the courtroom one day. And if I'm going to have to explain it to a trier of fact, I have to keep it as simple as possible. Today's topic is business valuation during a pandemic. We're in one of the most severe economic downturns that we've seen. I've been doing business valuations for 30 years, since 1990. I've seen a whole bunch of downturns. In fact, I started my career in forensic accounting and business valuation because of the economic downturn of the real estate market in the 1990s. I was working for an accounting firm whose clients were having problems being a going concern. There was bankruptcy issues and so on. So I jumped ship from traditional accounting and got into business valuation during what I thought was a Great Recession or something near a depression level. I was only 25 years old back then, much younger, and didn't realize how bad it could get. 1990 was nowhere near as bad as the Great Depression and some of the economic downturns that we've seen since then. The point of that background is the economy and businesses and industry go through cycles. And we've seen so many cycles over the last 3 decades. The downturn in 1990, we recovered in 92. There was a dot-com bubble blip in 2000, and the economy took a step backwards. There was a mini recession after 9/11. We recovered. We're going very strong. And then the economy took a big turn south with the Great Recession, saving and loan fiasco in 2008. And then they rebounded 9 in 2010, and we've gone through the best economic expansion we've ever experienced, only to be hit up about 14 weeks ago with business shutdown and an economic situation that we've never seen, with more Americans unemployed and out of work than experienced since the Great Depression nearly 100 years ago. We're in bad times. But back then, during the Great Recession, 1929 to 1939, there was something else going on as well: prohibition, another horrible thing. Government shut down businesses, and those that were in the distillery and the brewery business had no business, no cash flow. So the government, for those that did behave and follow the rules, the government compensated those businesses by valuing the loss of value, or the diminution in value due to the close down. Now, you close a brewery down, you don't lose the value of the land and the building, but you do lose the value of the cash flow from the going concern. So the IRS back then, which had been around since 1862, assisted with the valuation. And now we have a history of the US government getting involved with valuations. Larry, did you have a question?
No, I'm just seeing if there's anything in the chat, that's all.
Okay. So the IRS got involved with valuations back then, and they've been involved with valuations ever since. As a CPA, we have to follow certain standards, and I'm going to share screen with my presentation, and let's see if that works.
There you go. Beautiful.
You can see the introductory page.
Yep.
I'm on slide 2. The valuation expert, as a CPA, has to follow professional standards such as the SSVS 1 and USPAP. And I'm going to go into some of the basics so that you can understand how the valuation works and how it would be changed during an economic downturn. So with these standards, we have to describe the scope of work, the data relied upon, assumptions and limiting conditions. And that's very big today. What assumptions are we using? And what are our valuations analysts' representations and certification? And we have to sign off on our valuation work individually, not just with a corporate name. And if we're doing work with the IRS, we have to present our qualifications to show that we are able to do this valuation work. We're qualified. So if we're doing a valuation for a transaction, the CPA has to know what the client's selling. Is it a stock sale? Is it an asset sale? Or is all the working capital going to be included? Is it a cash on the barrel, or is it an asset, or is there an earnout and a potential attrition adjustments, which might minimize the risk and increase the reward for performances? Is there an ownership transition period? You know, are we valuing a dental practice the day after the dentist passed away and she did not bring in someone to take over the business? That's a lot different than valuing a dental practice where the proprietor brings an associate in, introduces them to the patients over a 2-year period, and then transitions out. That's a nice example of a smooth transition.
So Phil, if I can interject real quickly, again, the purpose of the valuation may determine the goals of what you're looking for in a valuation. A lot of times valuations are done for estate and gift planning, in which you're going to be looking for different types of discounts to take to leverage the value of what you're giving and come up with a lower value. You may have a valuation in conjunction with a marital dissolution when you have two different sides valuing the same asset and each side coming up with a different value. So value is definitely very subjective.
Marital or business dissolution.
Or business. I was going to get to
partners or shareholder dispute. Yep.
Partner dispute. Phil, are you going to address the difference between, I guess, fair value and fair market value? Are they, and are they different?
Hey, Phil, excuse me 1 second. You have to just, down the bottom, there's people in the waiting room when we turn it over to host.
Oh.
You sort of have to let them in because a couple people got knocked out. So sorry to interrupt.
Neil, is that something that Larry can do, or is that something I have to do?
No, you have to do. Down the bottom, it'll say participants, it'll say people in the room, and you just click it up and you say admit. See it?
Yes, I do.
Perfect. Thank you. There you go. Oh, people are reconnecting. Good stuff.
Okay, I'm sorry.
And I think I took care of all three that were waiting. Neil, just prompt me if I don't see that notification pop up as I'm looking at.
I only know from text. That's all I know.
Okay, very good.
Okay.
So yes, I am going to speak about the standard, and let's jump over to that as well. But before we do that, another purpose of the business valuation, life insurance. And buy-sell expectations. With Neil on the presentation, we always have to speak about life insurance. And that gets us to our next question, the standard of value, fair market value. If we're doing a transaction, most likely we're looking for a fair market value valuation. Whether it's a transaction, whether it's estate and gift tax purposes and planning, life insurance purposes, estate, a matrimonial or shareholder dissolution, generally fair market value is the way to go. Fair value in the legal context is just like fair market value, with a slight difference that we don't penalize the minority shareholder under a fair value calculation. And then there's also fair value for financial statement preparing, and that's a different topic, which closely aligns to fair market value. And then there's also intrinsic value. Now that generally, or investment value, and that's generally not considered fair market value. It's a specific value to a targeted buyer or seller, and would come in play when mergers and acquisitions are being considered, as opposed to a standalone business purchase. If I'm a competitor and I'm looking to buy someone else's business that's in a tangent line or a similar line as mine, I'll realize additional savings in combining back office support and so on. So that business could give me more cash flow than it could give Larry if he was to buy it and operate it as a standalone business.
Which may lead to a premium in terms of the value of that company that's being the target.
Oh, sure. As you move from fair market value to investment value, the value goes up. So fair market value, I suspect everyone's heard the definition of fair market value, the price at which property would change between a willing buyer and a willing seller, neither under any compulsion to buy or sell, and both parties having reasonable knowledge of the relevant facts. I read the last line specifically, and I'm going to repeat it. Both parties having reasonable knowledge of the relevant facts. That's a hard thing to know today, because the business may have been very steady over the last 5 years, but I suspect most businesses have gone through a big blip and are a little different today and will be different again tomorrow. So knowing the relevant facts of what you're acquiring may be difficult in today's environment. My next slide just speaks about the fair value and the differential on the minority shareholder litigation. So that's a little redundant. In addition to the standard of value, fair market value, you have to consider the premise of value. Most of the time we're considering a going concern, but sometimes the value premise is something less than a going concern, and it will yield a lower value generally. Sometimes a asset-rich industry, a manufacturing facility, or another asset-intensive a type of industry might sell, or a company might sell for the value of its underlying land and building, as opposed to the value of the going concern. Years ago, and part of the reason why I'm a forensic accountant and business appraiser is one of our biggest clients as a public accountant and an auditor, with $100 million invested into the property, the business owner was barely realizing 1% return on his investment. It was a rock quarry mine on hundreds of acres of property with buildings and equipment and so on. That pile of stuff was worth more sold off than it was as a going concern. And eventually that rock quarry turned into a hydroelectric plant, and the business owner retired a happy, wealthy individual. So as we move down the premise of value, orderly liquidation or forced liquidation, the value results tend to be less and less lower. For valuation, whether we're valuing a business, real estate, a gem, or a piece of equipment, there are three approaches: asset, market, and income. And that's universal. Every real estate appraisal considers a market approach. Oftentimes they'll consider an income approach. Rarely will they consider the asset approach, because who cares what it costs to build a building when the next door neighbor's building is being sold for $300 per square foot. So they rely on the market approach. In business valuation, it's the same thing. We consider the asset, the market, and the income approach. Oftentimes for an ongoing business, the asset approach just shows us the floor to the value conclusion, and that's the value of the assembled assets. All three valuations have in common three variables: the economic benefit or cash flow divided by the risk associated with that cash flow less growth. So risk less growth, risk is the discount rate, less growth converts the discount rate into a capitalization rate. And if we divide a cap rate into an economic benefit or cash flow, we arrive at a value. And that's a fairly simple algebraic equation. Let's go through an example of a current business valuation, and we're going to use the example of a local Long Island bus transportation company. The historical balance sheet is presented on the first column to the left, and that shows total assets of 4.7 million, liabilities of 2.9, and net tangible assets or book value of $1.8 million. However, that's a historical balance sheet on the tax return that doesn't necessarily reflect economic reality. And in this instance, we're going to assume that the inventory has actually doubled and accumulated another $2.2 million in value, up to 4.5. And the fixed assets, the equipment net of depreciation, has actually gone up to $6.5 million through appreciation and the write-off of purchases, repairs and maintenance and so on, as well as the land. Land and property and building tends to get depreciated, or buildings get depreciated, but the value, the net book value goes down while the fair market value goes up. So
right. In many cases, you find some what we call under recorded assets on a balance sheet. In this case, you have, I guess, excess depreciation that is reducing the value of the equipment over a faster period than it's being used. And I think you mentioned you're using a bus company. Traditional larger buses, the 44 passenger seat buses, last roughly 15 years when they're in service, but generally for tax purposes, they could be written off over a 5 or 7 year period. And, you know, accounting, I guess you could vary. If you're looking to adjust your earnings flow, you could use, you know, the useful life or anything there between. It's management representation. So
And we don't want to get bogged down with the depreciation write-off. We may want to consider this valuation on a cash flow basis and look at it a little bit, look at the cash flow a little bit higher than the net income to account for the non-cash entries like depreciation. And here we've set or reset the net tangible assets from 1.8 million to nearly $12 million. And this is a typical adjustment on an asset-heavy company. It's also a typical adjustment that we'll see on for the inventory for many businesses, as it's a common mechanism for deferring income taxes and paying capital gains eventually, or avoiding the earnings, ordinary income tax on the accumulation of the inventory.
So Phil, if I could interject for a second. For estate planning purposes, the business owner dies. Somebody has to mute themselves, whoever's child that is. That's all good.
I got it.
So my question is, for estate planning purposes, you have a business owner, say it's a sole prop, and they have this big variation in the value of the business. How does the IRS look at that business? It could be a Larry question too, I don't know.
Yes, we're very cautious about how we adjust and describe our adjustments for valuations that are going to go to the IRS. It's not likely that you're going to see that inventory adjustment on the balance sheet quite so blatant.
Just to add also, for those not familiar, if you're doing a transaction in which you're gifting, or even an estate tax filing in which a valuation was undertaken, you're attaching that to the tax filing for either the estate or the gift return. So you don't want to be in a position contrary where they're showing a much higher valuation or income approach adjustments.
It's a sensitive matter. In the courtroom, I will say that tax improprieties, the trier of fact will threaten to bring the IRS into the courtroom. But nowadays, it's rare that the IRS will even show up or take action if they do. So it tends to be a toothless threat to try to get the matter to settle because of inappropriate tax treatment and things like understated inventory. Looking at the second approach, we just did the asset. Now the market approach, we have an earnings or an EBITDA of $1 million, and using a private company transaction database, we developed a multiple of 6.5 times the earnings, and the implied value would be $6.5 million without any consideration of any adjustments. On an income approach, we use a similar $1 million cash flow, grow it to next year's anticipated amount. That's our future anticipated earnings being cash flow being $1,050,000, which is a 3% growth factor. And we divide that by the discount rate of 23% less growth of 3, which results in a capitalization rate of 20. That cap rate is reciprocal is a 5 times earnings number, 20% or 5 times earnings. 5 times $1,050,000 is $5,150,000. That's an example of an income approach using a single period capitalization of earnings, assuming that those earnings are constant, which is a rough assumption to make in today's times of any earnings being constant. Our next slide shows 4 $10 million companies with different earning levels, say 10%, 20%, 30%, and 40%. Company 1 represents our target company with the income that was reported on the tax return. Company 2 represents the average industry, or what we would expect in looking at benchmarking data. And that tells us that we have an issue with the earnings on company 1, and there may be adjustments required. The graph or the line in this graph is supposed to indicate that as earnings go up, value goes up, which makes sense. If we're going to increase the denominator, if we're going to increase the numerator on our equation, then the resulting value, as cash flow goes up, the resulting value goes up. Now, we just looked at benchmarking data that told us the company's earnings may be requiring some adjustments. So what are typical adjustments that we consider in doing evaluation? The number one adjustment tends to be owner's compensation. Oftentimes, small businesses bonus out all of the earnings in the form of owner's compensation. Other times, they leave the majority of the earnings to fall down to the bottom line. And there's also times when they pull out earnings in the form of discretionary spending or perks and don't pay any tax as owner's comp or net income. There's also extraordinary items, non-recurring items, unusual items, or items that won't repeat if the business was to be acquired by another business owner, or in cases of things like fires and such, or moving expenses. Those don't typically reoccur. So either the appraiser should smooth them out over a multiple year period or eliminate them altogether. I did a valuation recently of a large hardware distributor, and it seemed like every 5 years there was an extraordinary event. 1 year it was a move, another year, 4 years earlier it was a fire, and so on and so on. So for that valuation, we spread those extraordinary items out and only took a quarter or a fifth of those expenses each year. If they're non-operating assets, maybe the business owner has an airplane and he likes to fly his plane to conferences and so on, and spends $1.5 million in related expenses when commercial flights might have only cost $400,000 for the same type of travel. So there's $1.1 million in additional add backs, and you have to carve that airplane off the balance sheet, value the company, and then put it back in at the end. And when we normalize earnings for most valuation purposes, we're going to consider a tax impacted earnings on our cash flow analysis. And if we're doing it for investment or intrinsic value, consider synergies relating to mergers and acquisitions and any cost savings as adjustments to earnings as well. So my next slide shows a history of reported earnings of $1.8 million, $1.6 million, $1.9 million, $900,000, and $1.1 million in the last 5 years. Well, the last 2 and 3 years average is a straight $1 million number. If we were to bring in the 2016 and 15 performance numbers, that would distort our average up higher. And it looks like from the graph on the bottom right side of that slide, that the earnings have stabilized out at the $1 million level. And that's what we start with this business. We did the valuation with $1 million, 6.5 times multiple gave us a 6.5 times, $6.5 million value. But the normalizing adjustments here now quantified with owner's compensation being $500,000 higher than market value. If we were to replace the owner, we'd have to pay management $250 instead of the $750 that the owner took. If we replaced ownership with management, we wouldn't give the management a $75,000 perk package. We paid for the majority of their health insurance and a little auto, and there'd be a $50,000 add back there. Inventory was being accumulated, and that required an annual adjustment of $150,000. If you defer your increase on inventory for 10 or 20 years, you can see how that $2.2 million adjustment to the balance sheet is necessary. And there's also a P&L effect. Sometimes that accumulation of inventory stops and you just have a balance sheet adjustment with no income statement adjustment. You have to ask the questions. And oftentimes there's a related party renting, and there's either an increase or a decrease to earnings for above or below fair market value rent. The combination of those normalizing adjustments were $850,000. So that EBITDA number that we started with at $1 million has now increased to $1,850,000.
Bill?
Yes.
Bill, can I just ask, maybe you should explain what EBITDA is. It's the second time you brought it up. I'm not sure all the people attending know what it means.
And I've been using EBITDA and earnings interchangeably. EBITDA is an accounting term for earnings before interest, taxes, depreciation, and amortization. So it's a pre-tax cash flow type number before the interest expenses is considered.
Interest expense being a financing decision as opposed to an operating decision, and depreciation obviously being a non-cash item that's in your financials.
And it's a recognized standard or level of income. And oftentimes businesses are sold based upon that EBITDA level. As a side note, businesses that have EBITDAs of $1 million or more tend to sell for higher multiples than businesses that have EBITDAs of 300,000. If you're not in the 7-digit number, your EBITDA multiple tends to be a 4 or 5, 4, or even lower than that. After you get past $1 million, you start to see that EBITDA multiple increase. At least that's what the transactional data shows us. And
That's the venture capitalists and the investment bankers are always focusing on EBITDA.
And oftentimes they're paying for larger companies, EBITDA multiples now of 8, 10, 12, 16. I'm doing a valuation now with multiples in the 16 times range. And I'm trying to prove just that 12 or 14 is reasonable and should have been paid out to our minority shareholders when they were thrown out of the business just before they were sold for 10 times more than they were bought out at. I also mentioned tax adjusting. We do the tax adjusting to bring the earnings level to what the cap rate would be derived from. It's because public company data is presumed to be tax impacted, so we'll take a tax impacted cap rate and apply it to a tax affected cash flow. This graph is meant to show with lower risk, there's greater value. And lower risk means a lower discount rate. So the lower the discount and capitalization rate is, the lower the higher the value is. If we're subtracting growth from that, the higher the growth, the higher the value. So, and how do you develop the discount rate? You use generally a cost of capital method called the build-up approach. And if your company is over $50 million in equity, you may consider a capital asset pricing model, or commonly called the CAPM, where they use public company industry data for developing the betas and applying the systematic risk. Let's talk about the simple build-up approach that's commonly used for smaller mid-sized entities. You start with a risk-free rate, add to it an equity risk premium, and this is rates that are reflected in the marketplace, and empirical data is available to quantify these numbers. There's also a size discount because generally speaking, we're dealing with companies that are on the smaller side. And the publicly traded companies, the lowest decile in the publicly traded batch of data shows companies that are in the $50 to $250 million capitalization size. And oftentimes a Long Island business is substantially smaller than that $50 to $250 million equity. So we add a size premium to that. If we look at the first 3 attributes, risk-free, equity risk premium, and size premium, there we're at a 15% a discount rate. And that's the discount rate for the average company in the public market that falls within the smallest 10% of the company sizes. But the companies we're valuing, our Long Island Bus Company, it's not a $50 million or a $250 million company. It's a much smaller company. So we add additional company specific risk to that. In this case, I used a number that was about 50% of the overall discount rate, bringing my total discount rate from 15 to 23%.
Phil, how would you determine what is an appropriate company specific percentage? I know you use 50% in this case, but let's say it was a service-based industry versus manufacturing or a distribution like a wholesale or retail. Are there any specific guidelines by industry?
There is no set empirical data to quantify that. There's a lot of professional judgment, and there's risk assessment where we're looking at the history of our subject company we're looking at the financial performance of the subject company, the financial strength of the subject company, and that's helping us to quantify how much more risky is this business. And I'll tell you, if you don't add on a substantial piece, and I'm going to go back to that slide, oftentimes my subject company discount is equal to the subtotal from before. So it could be as much as 15%. It may be the same as my small company premium. I might use the logic that the company we're valuing is that much smaller than the publicly traded companies. And if the 10th decile it commands a 6% premium, well, then maybe my company that's 10 times smaller than that, or 5 times smaller than that, requires another 6% premium. It's a difficult number to defend. It's also a difficult number to attack. So that's helpful. We don't generally use industry premiums. Instead, we'll use the company specific premium. Industry premiums are based upon publicly traded companies. They tend to be diverse. They're quite often large. Included in the bundle can be failing companies or boom companies. And those premiums do not generally apply to small or medium-sized companies that we see on Long Island. So we spoke about how to develop a discount rate, 23%. Less growth equals a cap rate of 20%. And that growth is a long-term sustainable growth. It can't be what the company is just occurring just today, unless it can incur that growth forever. And forever is an awfully long time. So when we use a single period capitalization of earnings, we'll assume a growth rate that's constant. And we generally use the inflation rate, which is ranged between 2 and 4%. So for years, I've always used 3%. In the last 5 years or so, I've been on occasion using 2% growth because we've seen inflation declining. In the beginning of the presentation, I spoke about cycles. Industry, the economy, and businesses all have cycles. You have to know where you are on the line of your business life cycle for estimating future cash flow and growth projections. With the higher growth rate, the capitalization rate is lower, and we know if we have a lower cap rate, we have a higher.
1 second, Phil. We're getting some feedback from somebody. It might be just from your cell phone or external noises. Please try and control that. I'm sorry, Phil.
Okay. So with higher growth is greater value. If we go back to that slide before, and I change my growth factor from 3% to 20%, my cap rate would not be at 20% anymore. It would only be 3%. And that multiple that was 5 times the reciprocal of 20% would then be increased from 5 to 33 times. And 33 times multiple is an unrealistic multiple. So a growth rate of 20% yields an unrealistic value. You may be growing at 20% today, but you can't assume that you'll do that forever. If a company was to grow at 20%, within a lifetime, they take over the world economy. And that's not likely unless they're Amazon. So we looked at the market approach and the multiples that came from private or public companies. And most of the times we're using private companies. We'll adjust those multiples for our company's profitability, financial status, and financial condition. We'll rank our company and adjust those multiples accordingly. You got to recognize that in transactions, there can be premiums paid. So some of those transactions may be a little bit high on the multiples. So there could be reason to bring down the multiples. And there have been studies that show that premiums of over 30% have been typically paid for private transactions, causing BRS, buyer's remorse syndrome.
Right. So in an acquisition premium, what are some examples of why there would be an acquisition premium, such as like trying to achieve vertical integration in a particular industry or a roll-up strategy? What are some examples that you've seen?
Oftentimes the acquirer thinks he can do it better than his predecessor. and they build in their valuation model savings that they never realize. I think that's the most common cause for the premium to be paid. Or they're looking to capture market share and they're willing to overpay to get to that new level. Next slide is value drivers and decreasers. And I added to this slide the pandemic impact with government restrictions, businesses being closed, limited employees, and wary and sparse customers who wants to come into the store. If we open up,
supply chain interruptions. I mean, that's a big, big issue, I guess, which is impacted by that.
Before the pandemic started, I was in the midst of a transaction for a company buyout. The employees that had a 20% share were going to buy out the 80% shareholder. They were in the business of educational consulting. Their primary client was New York City Board of Education. I was doing the valuation in early February or early March, and they called me up and told me they're shut down. There's no work. They can't complete their contract with the Board of Ed, and they're on a pause. So they're going to put the deal on pause and the valuation work on pause. And that transaction is questionable of whether or not it's going to go forward.
So Phil, what would you do in that case if you had issued your report, let's say in early February, before this was deemed a pandemic, and there was evidence of the virus spreading, but not the way it ultimately happened. So you issued the statement with a higher value. What is your responsibility? What is the company's responsibility?
I'm going to go with one of the statements I said before in our professional responsibilities. We have to use the known or knowable premise in doing our valuation. And if we issued that report with a February 1st valuation date, and that report was issued on February 28th, well, none of this shutdown and business being closed was known or knowable as of that date. But so there is no responsibility for the business appraiser who issued a report on February 28th regarding a February 1st valuation to speak about subsequent events that were not known or knowable as of the valuation and the issuance of the report. But let's say you're doing that valuation for estate purposes on February 1st, and we're doing it today. I've got a whole bunch of January valuations that we were going to start in February or March for estates, individuals who've passed away and require business valuations. Just about every single one of them are going to use the alternative 6-month valuation date and value everything 6 months later. The first one I got was a business that was worth somewhere in $20 million range, and the deceased owned a majority position of that, and they had securities. When I had the conversation about the business valuation date, the date of death was January 5th, and the market was down 30% in early March when we had this conversation. So I suggested, knowing that my business was going to dry up a little bit and the office was going to close, I suggested, for the benefit of the client, let's push this valuation off 6 months. And I deferred some of my revenue for that project by 6 months because I assumed that the market would stay depressed. It dropped from it looked like it was going to hit 30,000, the Dow Jones Industrial, and then dropped to the high teens, the huge drop. I assumed that it wasn't going to pop back up to 26,000 as it did over the last couple of days. But overall, it's going to be a lower estate in July. If we were issuing the report, we'd have to disclose the subsequent event of the pandemic and get that in the report so the reader's informed. But the value as of that date is a set dollar amount. Almost comes to the who cares what it was back then. It's not worth it now. But for certain purposes, you have to use a specific date, and that's what's important. I always include an elevator of value slide in my valuation presentations. On the bottom of this slide, the lowest value is the minority non-marketable value. towards the top, we get the fair market value with the controlling interest. And at the very top, we have a controlling interest with an investment value. And that's the highest value that we'll generally see. We'll just mention that there are discounts for lack of control and lack of marketability. For estate planning purposes, we can take advantage of those discounts, especially if we're gifting less than a controlling interest or pieces of a controlling interest to different parties. Then that becomes minority or non-controlling interest as well. Those discounts tend to be up to 30 or 35% without too much risk of IRS intervention.
Just want to interject real quickly, since we have a lot of financial planners and people involved in the estate planning arena on this call. Obviously, now is a great time to be looking at gifting opportunities. You know, right now we have very high thresholds for estate taxes. Assuming that there's going to be a change at the top leadership in this country, and they're going to need to raise taxes to pay for this whole pandemic, estate and gift taxes rates are going to go up, or correspondingly exemptions will be cut. Right now, the federal's just under 12 million. I'm sorry, 11.6. It's about 11.580. New York State is just under 6 million. It's a great time to do some gifting in terms of your planning. Take advantage of these different minority and lack of marketability discounts to get as much out right now as you can.
Yeah, so with the economy the way it is, being down, for estate planning, down tends to be a better way to value the companies with a lower value and pass it on to the next generation so that they can realize the appreciation and not pay the taxes, defer the taxes down the road. Now, what's happened since January 1st has been significant. And the first piece of empirical data that influences our valuation is the risk-free rates. And the risk-free rates actually went in the opposite direction of where you'd expect them to go. Rates were incredibly low at the beginning of the year. They fell even further. The 10-year rate dropped by 1.2%. The 30-year US Treasury rate dropped by 1.7%, from 3% down to 1.3%.
So Phil, from this, if let's say my operations in 2020 were very similar to 19 or 18, with this drop in interest rate, are you saying now that on a valuation, companies would be more valuable?
Yeah, that's what the data implies. But I'm not saying, I'm saying that the data implies that, but you have to apply the data correctly. And you can't just look at one piece in a vacuum. We spoke about the valuation formula, economic benefit, risk, less growth. Well, the risk is the discount rate, and the pieces of that discount rate are the risk-free rate is falling. But is the discount rate really falling? Now let's get into the valuation model that we spoke about. In the first two columns, I'm just going to change the rate. And Larry, you set me up perfectly for this model. If I just change the rates, my capitalization rate under this example goes from 10.5 or a 9.5 multiple to 8.8 or an 11.4 multiple. 9.5 versus 11.4, that's almost 2 times more value or 2 times more earnings as our value conclusion. And our value went up from 17 million to 21 million in this example, or a 20% increase just because of rate change. But you can't just change the valuation formula for the risk-free rate, because at the same time, other things are changing, such as your earnings expectation and your growth expectation. So I'm doing this value and the risk associated with achieving those earnings. So I'm doing this valuation, decreasing the risk-free rate. But when I get to the company-specific premium, I've increased the 2.5 to 3.5. I only increased it by 1 point. Some of the more published and learned scholars in the business valuation world are coming out and saying that they're increasing their subject company premium by at least 1 percentage point during these hard economic times. I think 1% is a little bit on the low side and it probably should go up higher. But there's other ways to correct the formula. And another one of those is the growth factor. I'm not applying growth for many of the business valuations. So we can see how our cap rate went from 10.5 to 12.8, that's actually a decline of 1.7 times, or nearly 20% decrease in value by changing our capitalization rate attributes. And I've also normalized my earnings at 80%. And I'll say I didn't do that. The company I'm valuing has projected that next year's earnings and thereafter are going to only be 80% of what they had been in the past for various reasons. That's their projection. So using a revised cash flow projection with a revised risk factor gets me a value conclusion of 11.5 million instead of the 17.5, and that's a 34% decrease. That's more reasonable in today's times. But this is a single period capitalization of earnings, and it assumes that that cash flow is a constant forever number. And that's a difficult assumption to make in today's times. But what's our alternative? A multi-period valuation model known as a discounted cash flow? Are we going to expect that our business owners can give us a 2, 3, or 5 year cash flow projection with figuring out what it's going to stabilize out at in the terminal year, whether that terminal year be 2024 or 2026? How many of us, by show of hands, know a business owner that can give us accurate projections over a 5-year period in today's economic environment? It's very risky to assume we can get accurate numbers. So that's a dilemma the valuation experts are faced with today. But bottom line is, I see the values going down in the current environment, and let's take advantage of them as we can. Questions?
So just want to interject real quickly. At this point, we want to see if anybody has any questions related to Phil's handout. But then after this, we'd like to go over through like a mini case study and get everybody's participation on how a particular industry was impacted by this whole pandemic. So if you have any questions regarding to the handout, now would be a good time for that.
Phil, hopefully you can share the handout with us and we can get it to some of the participants who've asked for it.
Oh, sure.
Okay.
Yeah, that's a PowerPoint presentation. I'll be glad to send that over.
Okay.
So Phil, in your example, you used a transportation company. It was a school bus operator. And from what I know from school bus operations, starting in around mid-March, they were basically shut down. These transportation companies have had no, I'm assuming no revenues. I don't know how the contract, each specific contract provides for, but they've had no operations for the last 2.5 months. It doesn't appear that they're gonna have operations until September, and we don't even know what September holds yet. We saw one large family business, Long Island operation, shut down.
I was just going to mention a bus company that starts with the letter B, I believe, is bankrupt.
Correct. They filed for bankruptcy. I believed they are being acquired by a national school bus operator. But again, here's an industry that most of us have taken advantage of in our lifetime in terms of our children's transportation to school. They're shut down. Clearly, the company's valuations are impacted. The question is about operations going forward. We don't know that if and when schools will begin again. And the question is, can you first of all, can the schools operate at a live capacity where they were prior to the pandemic, or will they have to go to a split schedule, which means changing of the transportation routes, which impacts the school bus operator? I don't know if it's positive or negative.
Could double their activities. Would that
not double their income though, because you don't know what the contracts provide for. They may have to go on either split days or split shifts each day. The other question is, can you get the same amount of students on a bus that you had pre-pandemic versus post-pandemic, assuming we're out of the woods in September, so to speak?
Right. Yeah,
So
I wanted to use this.
Have any comments in terms of how this industry is impacted in terms of the valuation and how operations are going to be affected?
I would look to the industry publications to see what they are projecting for their industry. And I suspect it's still a big unknown as school districts are wrestling with how they're going to come back of full force. With the bus industry, and I like this as an example, it's difficult to know whether they're going to be business as usual come the Tuesday after Labor Day, whether they're going to be boomed with additional work related to a split schedule or additional busing requirements because of social distancing requirements, or are they going to be squeezed and have less work and lower margins and lower cash flow?
Right.
So there's a big uncertainty with what's going on with this industry's cash flow going forward. And it could possibly be regionally based as well, because the busing issues in South Dakota and Arkansas may not be as significantly changing as they are in New York and California.
And in terms of valuation of the company, in terms of the asset model, the question is what happens to the equipment, in this case, school buses, if they're not being used? Are they depreciating slower? Are they depreciating faster? How are they holding their value?
Right. In the beginning of this model, we did a valuation on the asset base and adjusted those assets to just below $12 million. That number wasn't a coincidence. I say that that's the floor of the value and the value of the assemblage of assets. And yet, revised valuation with an $11.5 million value conclusion on the cash flow. That makes me think that my value on the cash flow is probably right on track as it's closely approximating that low value on the floor of value on the asset-based approach.
Right. So the question now, as either an investor or as an owner of another transportation company, is this a good time maybe to be doing acquisitions because values are down? We believe at some point in time, all these children will need to be transported to schools, that the business model is going to be held intact because we're not shutting our schools permanently. Do you think this is a good time maybe for acquisitions and that you might find undervalued companies?
I think this is a time to find bargains because there is an incredible amount of uncertainty and risk. And with uncertainty and risk, the discount rate goes up and values go down. I could just easily say with additional risk, values go down. I don't have to get into the formula. That's an easy concept to understand. As the cash flow is riskier, the value of the underlying assets are lower. All else being equal.
Right. I don't know if anybody out there has any comments or questions. I don't see anything in the chat room. If anybody wants, Neil, you have anything to throw in?
I just want to say having the value of Phil and Larry Shear and all these experts in the organization is so interrelated to everything we do. And it's so important that we understand that whether we're in a buying mode, whether we're selling our business, whether we're helping out a client doing a mortgage or buying insurance, and we need an evaluation, we have a team of professionals here that can help you make things happen. And I think that's the important thing of the organization, and what we want to stress here is that we all have our expertise in areas, but having this advisory board available to everybody is very helpful to our businesses. And I think it's great and fantastic, and is all going to help us tremendously. So I thank you there.
And you might want to just add that all of us are available. You know, that's the great thing about the network, is that you can call someone and just say, I have a question, even if there's no business involved. We're all willing to work with you, because if the tide rises, all boats go higher.
Well said.
Absolutely. I am available to discuss business valuation and benchmarking data. I don't need a client code. If you have a question, give me a call. I'll spend a few minutes with you. I have a great database and good information at my fingertips.
You know, for all you advisors out there, in whatever capacity you serve your clientele, now is an excellent time to be looking at business valuations, either for estate and gift planning purposes, or even, you know, economic viability of your client's, business, to see maybe now's the time to get out, or maybe now's the time to go on an acquisition strategy. So, obviously, even situations such as a pandemic present opportunities, and you have to look for opportunities where they exist.
Yeah. Can I give a example of where valuation really helps? We had a client that had promised a 10% interest in a business when certain benchmarks were hit. The employee reached the benchmark, and then right after that, the company lost its biggest client. It was questionable whether they were even a going concern. Getting the valuation on that date and issuing the stock on the date when the company was a questionable entity caused almost no tax implication to the employee who received the stock. Had they waited another year and the company regained its $25 million value, the 10% would have been $2.5 million income, and they would have paid a lot of money in tax.
We have a question here from Danny Schulman. Once the valuation is complete, how long is it good for? Does a transaction need to happen within a certain time frame of the valuation? Excellent question. Obviously, valuations go stale. Phil, what do you recommend in terms of?
I was going to say 6 months, and if you'd asked me that question 4 months ago, I'd say 6 months. But what if I did a valuation as of February 18th, and we're sitting on March 18th, 30 days later? That valuation's no good for a transaction. So it's fact dependent, but generally speaking, it's a 6 month. And when we do real estate holding company valuations, and you do one as of December 31st, 2019, we can do a gift in 19 and a gift in 2020 based on the same report. Even if you did it as of June 30th, 19, you can do another gift, maybe a January 1st. But don't
we usually use 6 months as a time frame as well.
I think that's the longest time. And I should probably defer to our attorneys as what are they comfortable with submitting? And most of the time they're at that 6 month mark at the very most, sometimes even less.
Exactly.
Doing an ESOP valuation, it's got to be updated as of the date that the company buys back the stock. 6 months or 9 months or even 3 months wouldn't cut it for them. They need a rep letter to get you up to a current date for the transaction. So it's fact dependent.
And each and every successive purchase would have its own separate date valuation. All right.
Thank you.
And on that,
Well, if there's any other questions, please don't hesitate to ask. Again, we're going to be having a blog on the website. It's going to be interactive. Members are going to be able to log in and do some different things. We're building this organization tremendously at a very fast pace. We're pivoting like we all should in businesses. We need to pivot. As things change, we pivot. As the bus company changed, they could be delivering food. They could be doing something else with these dormant buses. And I think that as the economy changes, we just have to be more creative. And there's always opportunity, as Larry said. So with every pandemic, there's opportunity. Whenever there's change, there's opportunity.
let's hope there's no more pandemics.
Yeah, we don't want to.
Yeah, God, no.
I've had enough.
Come on.
Yes. Thanks again. Thank you so much for a great presentation, Phil.
Thanks, guys. Thanks for
Thank
joining
you.
us.
All right, guys,
Take
have a
care,
great
everyone.
week. Happy Father's Day, everybody.
Yes,
Happy
you
Father's
too.
Day.
Thank you.
Happy Father's Day. Enjoy, guys.
Take care.
Yep.
Well, that went well.
Yeah, it was nice. Except he didn't announce the next meeting, but okay, we'll have to do an email blast.
Oh, yikes. Yes. And our, and now it's just the two of us. Our website does not have any events on the events calendar. So that's something we got to get up there. We're going to advertise the website. Let's advertise our events at the same time.
I agree. Good job, Phil.
All righty. Thanks.
Take care. Have a good day. Enjoy.
You too. Bye-bye.
Bye.